Welcome everybody. I'm Rita Offit. I'm the Loan Acquisition Manager for Idaho Housing and Finance Association. We have many partner state participants on this call. We had over 800 people register, so be patient with us today. John will take care of some housekeeping items. John Locke is our business development supervisor here at Idaho Housing. And we have two special guests from Freddie Mac. We have David Mendez. He is the affordable lending manager. And then we will have Jean Baird, who is a senior underwriter with Freddie Mac. And she's the one we're trying to get logged onto the call. She's the one with all the answers. So she's kind of instrumental in this presentation. So I'll let John go through some housekeeping items.
That's fine. Thanks, Rita. First, I want to say I appreciate you all being on the call. The response was surprising, but did obviously point out a need that's there and interest that you have, and understandably so in hearing from agency, in this case, hearing from Freddie Mac. So we really appreciate them being a part of it and allowing us to get this set up. We were talking offline prior, and we will, going forward, because of the interest, we'll start offering these calls on a regular basis with varying emphasis and subject matter. But this is something that we want to do going forward for our partners. So you can look forward to that. So a couple quick housekeeping items. Obviously, we have a Q&A and a chat. You can enter questions in either one of those. Because of the size of the training, we are going to have Q&A at the end, but it's not realistic that we'll get through all of your questions. So we will be able to pull the questions from both of those, the Q&A and the chat. And we also will be sending out a survey following the call, which will, one, have a link to the presentation, because as Rita mentioned, it is being recorded. And also, you have the ability to ask questions as part of that survey. So please ask the questions. If you don't get it answered during the presentation, don't be concerned. We will capture those and follow up, likely get those questions answered within the next couple of days. And then you can always contact Rita or I here at Idaho Housing for things you need beyond that. We're always glad to help and piece something together if something didn't quite go right for you today. So it will be recorded. There will be an opportunity for questions both during the training or during the event and afterwards. So just hang tough and we'll get started.
So real quick, looks like Lisa is telling me there's an echo. Anybody else hearing echo? Will you put that in the chat?
I'm not getting any, Rita.
Okay, could be logged in twice, Lisa. So double check that. Okay.
And Rita, is there a dial-in?
There is not a dial-in.
Yeah, I watched. She shared her screen with me. When she clicks on it, it's kicking her out. But now she's trying one more thing, and it says that appeared to work. Okay.
Okay. If you're hearing an echo, there's a good chance you might be logged into this twice. It's very clear on this. Okay, so we've got one confirmation it's better. Somebody else is still hearing an echo. So double check that. It's very clear on our end. So unfortunately, I don't have any input for you on that.
Okay, she might be in now. Are you able to see her?
Jean, can you unmute yourself? There's 500 people here, David, so it'll take me a while.
Can you hear me, David?
Yes, perfect.
Yes,
we got you, Jean.
All righty.
All right.
Okay, so it's all you, David. You go right ahead.
Okay, let's go ahead and get started then. We're a little behind time, but luckily we scheduled this for 90 minutes, so we should still be okay. Thank you to everyone who joined. My name is David Mendez, Affordable Lending Manager at Freddie Mac, And I'm joined by one of our senior underwriters, Gene Beard, who will be assisting me with answering all of your Q&A questions. Before we get to Q&A, I'm going to go ahead and just do an overview of HFA Advantage. Then we'll talk about LPA and some recent changes to LPA through LPA Choice. I will mention DPA 1, which is a resource for finding down payment assistance programs. And then we will get to all of your underwriting questions. So as I go through this presentation, think about what questions you may have, and then go ahead and put those in the Q&A. Again, as mentioned, there are over 400, almost 500 folks. So we may not be able to answer all of your questions. If we don't, we will log those questions and then get back to you with those answers. So with that, let's go ahead and get started here.
Okay.
All right, here we go. So Freddie Mac HFA Advantage, and I'm actually going to go ahead and turn my camera off. There we go. So Freddie Mac HFA Advantage. So most of you are familiar with HFA Advantage if you're joining this call. The HFA Advantage mortgage is a conventional mortgage product available exclusively through HFAs seeking strategic solutions to diversify their product offerings and portfolio mix while expanding home ownership responsibly. And really all that to say, HFA Advantage is not a standalone product like, say, for instance, Home Possible. To use HFA Advantage, you would originate it through a housing finance agency. We know that there are many HFAs on this call today. We're covering multiple states, multiple HFA programs. So there may be some differences in each program, but again, HFA Advantage is used in conjunction with housing finance agencies. It's not a standalone product. With HFA Advantage comes some really great benefits that you won't see anywhere else. Starting with 97% LTV, it goes all the way up to 105% TLTV with affordable seconds. Those that are offered by Idaho Housing or whichever HFA you are working with generally count as affordable seconds. We will allow up to 95 and 105 on 2 to 4 unit properties. We also allow non-occupying co-borrowers up to 95 LTV and 105 TLTV. Now, I'll pause here to say these are general guidelines. Your HFA may have some stricter guidelines, so you always want to make sure you're always following the stricter of guidelines. And on top of that, even internally within your own lender shop, there may be some overlays. So you want to also make sure that you're following your own internal guidelines, whatever those may be, and following those as well. So moving on, we also do allow manufactured homes up to 95 LTV and 95 TLTV. The HFA sets the maximum income limits, unlike Home Possible that is capped at 80%. And so that's one of the biggest features of this program is that generally the income limits do exceed that 80% cap from Home Possible. So you're able to take advantage of a lot of great features and benefits that wouldn't normally be afforded to your borrower, but because it's the HFA Advantage program and because the HFA has set those income limits generally higher than 80%, your borrower is able to take advantage of those additional features and benefits that we'll continue to go over here. The HFA determines home buyer education requirements and who the provider is. There are credit enhancements, including custom level mortgage insurance coverage. And then depending on the LTV and income, the mortgage insurance may be all the way down to charter level. And we'll go over what charter level mortgage insurance is, but that really depends on the individual HFA and program that you're working with, your borrower's income level as well. We do allow flexible funding options for down payment and closing costs. In addition to the DPA that the HFA may be providing, we also allow for other affordable seconds. So it is possible that you could layer this program not only with the second that your HFA is providing, but there may be some local assistance available that you're able to layer on top of that. This is available to first-time home buyers, in many cases, repeat buyers, and in other cases, borrowers seeking no cash out refinances. Again, I'll mention that, for this particular training, it's being offered to multiple states. So every HFA may be a little bit different, may or may not allow some of these. So again, I just want to reiterate, follow the stricter of guidelines. And then finally, LPA, Loan Product Advisor. In some cases, manual underwrite, but not many. Again, so check your internal guidelines or alternative underwriting systems subject to prior approval. Why would you want to choose HFA Advantage over FHA? So first I'll say we don't sell against FHA. We want whatever the best program is for your particular borrower to be able to ensure affordable and sustainable home ownership. With that said, all things being equal, these are some of the reasons why you would want to choose HFA Advantage over FHA. And the first one is pretty big, and this is the reason why many people go conventional over FHA, and that's because the MI ends, generally speaking, when the LTV is at 80% or less. There are certain requirements. You definitely want to make sure you're checking with your servicer. A lot of times they do have to be in the property at least 2 years, 24 months. There may be other requirements, but generally speaking, the MI can end when the LTV is at equal to or less than 80%. Custom level mortgage insurance monthly premium versus FHA that not only charges a monthly premium, but also an upfront premium as well. The MI is only required if the LTV is 80% or higher. On FHA, the MI is required regardless of the LTV. And then there is no upfront mortgage insurance premium on HFA Advantage. For FHA, there is an upfront mortgage insurance premium that's added to principal and amortized over 30 years. So that upfront MIP ends up costing a lot of money once you calculate it over the period, the life of the loan. So what does that mean? With more funds applied towards principal up front, an HFA Advantage mortgage with private mortgage insurance lets the borrower build equity faster. So I talked about charter level mortgage insurance. And so here we are. These are some of the mortgage insurance coverages for borrowers who are earning equal to or less than 80% of the area median income. And it's significantly reduced. You can see at the top here, greater than 95 up to 97, the coverage requirement's only 18% versus 35% coverage requirement on standard conventional loans. And really what that equates to is a lower monthly payment or more buying power. So your real estate agent is able to make, or your borrower is able to make a stronger offer on a particular property because they have a little bit more wiggle room. And then we see down the line between 90 and 95, 16% versus 30, between 85 and 90, it's 12% versus 25. And even at 80 to 85, the requirement is 6% versus 12%. So significant reduction, again, just adding to overall affordability. And that's really what we're looking for. Freddie Mac Loan Product Advisor. We're going to give a high-level overview of LPA. So first of all, you want to select HFA Advantage in the offering identifier field within the mortgage type and loan term section of LPA. Now, what you're looking at may look a little bit different depending on what LOS you're using, but regardless of the LOS that you're using, HFA Advantage is the name of the program that you're looking for, or there's also a corresponding product code, and that code would be 251. So either you choose HFA Advantage, or you make sure you have that code 251 and you know you're good. Here's an example of what it might look like. Again, it will vary depending on what LOS system you're using. And there we see clearly HFA Advantage. Here are some of the other choices you might see from the drop down. Loan product feedback certificate. So once you've run LPA, you can always, again, double check to make sure you chose the right product by checking the offering identifier field. So verify the loan was submitted correctly by ensuring the value entered in the offering identifier field is showing HFA Advantage. This is found in the mortgage information section of the loan product advisor feedback. So within the feedback certificate, you're going to see this mortgage details section. And then within there, you're going to see it's either going to be called offering identifier, or if you're using LPA version 5.3 or later, it's going to say program identifier. And then you'll see the program name, which is HFA Advantage. Now, it does seem pretty obvious, but believe it or not, this is one of the most common mistakes we see, is that either they chose the wrong program or they chose the right program, but somewhere along the line through, changing and updating the loan, someone changed that offering identifier from HFA Advantage to something else, thereby, making them not eligible for the higher LTVs, the chartered level mortgage insurance. So again, even though it does seem obvious, you want to absolutely make sure you're choosing the right product. This is what you would do to enter down payment assistance for non-amortizing subordinate financing. And we're going to go over both. Again, we know there are multiple HFAs. So the programs may be different. Some may be amortizing, some may not be amortizing. So this is what you would enter if you're using a non-amortizing subordinate loan. So the creditor name, business type, lien type, you're going to put second lien. The non-amortizing, because it's not amortizing subordinate loan, the monthly payment is going to be 0. They're going to ask you for the loan amount. Is the other new mortgage an affordable second? This is key, and a lot of people miss this. You want to say yes, so that it doesn't include that monthly payment into the debt ratio. In this case, there is no monthly payment, but you still want to make sure that you're choosing yes. Is the other new mortgage an affordable second? So assuming it's from the HFA, it is an affordable second. If you're using local programs, you do want to make sure that it meets our affordable second guidelines. And then, is the affordable second payment deferred? And that answer is yes. Is it a HELOC? No, it is not a HELOC. Fund source type, local agency. Select the source of the affordable second from the drop-down selection. So here's a tip. If the affordable second does not require a payment within the first 5 years, or before the due date of the 61st monthly payment under the first lien mortgage, the monthly payment, initial principal and interest payment amount must be equal to 0. So again, if they don't have a payment within the first 5 years, the first 60 months, then the monthly payment should be 0. For amortizing subordinate financing, it's very similar. Again, creditor name, business, second lien. Here, you're going to enter the monthly payment, loan amount. Is it an affordable second? Yes. Is the affordable second payment deferred? No. And by clicking this, it's then going to know to count this monthly payment into the debt ratio, which you must do to make sure you're originating the loan correctly. Is it a HELOC? No. And then again, the fund source type, local agency in this case. So opposite of what the last reminder said, in this case, if the affordable second requires a payment before the due date of the 61st monthly payment under the first lien mortgage, the monthly PITI must be entered. And then I would like to remind you to make sure your line is on mute. I do hear some chatter in the background, so just make sure your line is muted. We have quite a few people on the call today. Mortgage details. After you've entered that second mortgage, you want to make sure that it was calculated. So when you're looking at the feedback certificate, again, in the mortgage details section, you're going to see that affordable second. Generally speaking, these two are the same, the affordable second and then total subordinate financing. Purchase eligibility and AUS risk class, loan product advisor feedback certificate results. Upon successful submission of an HFA Advantage mortgage, the following results are returned. The assessment summary section of the LPA feedback certificate displays purchase eligibility and risk class results for the transaction. So when we're looking at purchase eligibility, what we're talking about here has nothing to do really with the borrower's credit worthiness. What we're looking at here on this side is just making sure that you put the loan together within the guidelines of that particular program. Is the max LTV 97? Did you go to 98? Because if you did, then you would get that caution instead of eligible. So on this side of things, the purchase eligibility is just making sure you put the loan together within the guidelines of HFA Advantage. On the risk class side, now we're talking about the borrower's credit worthiness. And we're going to take a little bit deeper dive into both of these sections. So here's our example. We see purchase eligibility and it came up ineligible. Well, it's going to tell you why on the feedback certificate. And so here in the message summary, it's got these little bubbles and it says there's 3 reasons why the purchase restriction messages. So now if we look down into the purchase restriction messages section, which would be down a little bit further on the feedback certificate, you'll see why you received that ineligible. In this case, the TLTV was 98 and the max TLTV was 97. So you exceeded the LTV, the TLTV, and so you exceeded the product guidelines. And that's why you got the ineligible. So you may have the best, borrower with the highest credit score out there, but the program wasn't put together according to guidelines, and therefore you got the ineligible. The loan was submitted with a debt to ratio of 52, which exceeds the maximum allowable limit. In this case, there was a limit on debt ratio. That's not always the case. Taking a look at the risk class, now we're talking about the borrower. This is the borrower's credit worthiness. So in this example, you put the loan together, great. You followed all the guidelines, you're within LTV, debt ratios, all of that. But the borrower's credit worthiness was resulted in a caution. And here's some of the reasons why. So if you got this caution, you would want to check the credit and liabilities messages section. That's what corresponds to the AUS risk class caution. So in here, it's going to tell you why. So here, caution factor, credit history. Based on the credit report, a combination of credit history factors impact the risk class. Here's another reason, debt to income ratio. Based on the application, the qualifying debt ratio is 45%. So I'm going to stop here for a second. We've received a lot of feedback from the field about our feedback certificate, and more wants. You want more actionable items here, and so we've made some recent updates to LPA to help out with that. So here we see that all it's telling you is the DTI is 45%. But it's not giving you any additional detail. So you as a loan officer or underwriter, you're looking at this and you're saying, okay, great. You're telling me it's 45%. Obviously that's too high, but what do I need to do? Well, now we're going to include some actionable feedback. So you're going to know exactly what you need to do to get that approval. And I'll show you that on the next screen once we go through these other 2. So here's another example, loan to value. Based on the application, the LTV impacted the risk class. Well, we know that you're within the LTV, the 97% max LTV, because you got ineligible. So you're within guidelines, but this particular borrower is considered a higher risk. And so therefore, even though you're within guidelines of 97 LTV, because they're considered riskier, that higher LTV impacted the risk class and resulted in a caution. Well, again, we're going to provide you with actionable feedback going forward on many of these loans. So you'll be able to see what that looks like on the next screen. And then finally, caution factor, utilization of credit. Based on the credit reports, utilization of credit impacted the risk class. Usually, they might have, high balance credit cards, things of that nature, which could have resulted in this final feedback here. But now taking a look at the LPA choice. So these are the recent enhancements we did to LPA to provide you with more actionable feedback. So problem statement. When a loan receives a caution risk class, loan originators may be unsure how to proceed and might even consider it a hard stop, which is unfortunate, but it does happen. So you got the caution, you don't know what to do to remedy that. And so, unfortunately, you go back to the borrower and you say, I'm sorry, Mr. Borrower, right now you don't qualify. So we want to change that. We want to be able to change a lot more of those cautions into accepts. So for certain loans that receive a caution risk class, LPA choice feedback messages offer unprecedented information about our purchase requirements and actionable feedback that can help loan originators make faster informed decisions about how to proceed. A subset of caution loans will have an opportunity to flip from a caution to an accept. If your loan originators can provide the information identified in the messages and then resubmit it to LPA, the loan is more likely to turn into an accept. The LPA choice messages use dynamic data points for 3 specific loan characteristics. So we're looking at DTI, loan to value, and reserves. And this is what the feedback would look like. So if the loan receives a caution and a high DTI is the major caution factor, you might get a response that looks like this: debt to income. Based on the submitted income of $10,000 and total debt of $4,500, the qualifying debt ratio is 45%. Documentation of an additional $460 qualifying income may help meet established underwriting guidelines. Now, this first one might not fire for HFA Advantage loans. And the reason being is because HFAs set the income limits. And so now if we're suggesting you increase the income by $460, that might kick you out of the income limits for the HFA. On HFA Advantage, this one won't fire, but it will fire for Home Possible, Home One, and many other of our affordable loan products. The next one will fire. So the loan receives a caution and a high TLTV is the major caution. So here you're going to get a feedback that says loan to value based on the application data, an LTV TLTV of 97 impacted the risk class. Now again, before that's where it would stop right there. So you wouldn't know, okay, what do I do next? Now we're adding this additional line. Reduction of the loan amount by $6,000 may help meet established underwriting guidelines for purchase. Now you know what we're looking for here. So that's going to help you, make adjustments to that loan to get the approval that you're looking for. And then finally, the loan receives a caution and the total reserves is a major caution factor. So in this case, the feedback might read like this: based on the application data, documentation of an additional $75,000 of qualifying assets may help meet established underwriting guidelines for purchase. Now, I don't love this particular example because $75,000 is quite a bit of money that, generally speaking, most folks using HFA programs may not have access to. So I wish it was a little bit lower in this example, but regardless, that number will vary. So in your case, it might only be $5,000 additional reserves that you may need. But it's going to tell you exactly what those reserves are that you're going to need to give you a high likelihood that the loan is going to get approved. Now, it's not an absolute guarantee that if you change it, you're going to get the approval, but there is a high likelihood. Another question: what if both fire? Then it really depends. You may be able to just change the LTV and not the reserves and end up with the approval that you're looking for, or you may have to both change the LTV and the reserve. So it really just depends on your borrower's overall credit risk. And then finally, within the feedback certificate, you're also going to see some mortgage insurance messages. So here's an example. If they're within 95 to 97% LTV, and I'm not going to go over all of these, I'll just go over this first one. But if you're within this LTV, you're going to get this message. It says this HFA Advantage mortgage requires 18% mortgage coverage when the borrower's income is less than or equal to 80% of the area median income. Okay, and I'll pause here because some loan officers stop reading once they read that first portion. And we see that there are mortgage insurance, there are loans where the mortgage insurance was not correct because they didn't use the right amount of coverage. So again, I'll reread this. This HFA Advantage mortgage requires 18% MI coverage when the borrower's income is less than or equal to 80% of the area median income, and 35% MI coverage when the borrower's income is greater than 80% AMI. Refer to the HFA's website and or program guidelines for other MI options that may be available when the borrower's income is greater than 80% AMI. So again, because we have multiple HFAs on this call, your program may vary slightly. So definitely make sure you're checking your own HFA guidelines for MI coverage requirements. DPA1 overview. So I had mentioned before that in addition to the down payment assistance that the HFAs provide, there may be other local programs that are available to you. And so we've created DPA1. So Freddie Mac developed DPA1 as a free online tool to host down payment assistance programs nationwide and ease the matching efforts within the business-to-business mortgage ecosystem. DPA1 facilitates partnerships between housing professionals and DPA program providers in reaching the shared goal of helping more borrowers get into homes. So I'm not going to read the rest of it, but all that to say is DPA1, and you would spell it out, dpa1.freddiemac.com, is a great repository for finding down payment assistance programs, either at the state level or even at the local level. Now, we don't have all the programs. We're working on getting them all in, but we do have many. And when you log in to register, it's very easy to register. We're just looking for some basic information, name, email address, contact information. Loan officers can access this. Real estate agents can access this. Technically, borrowers could access this. All they need to do is go on and register, but we don't recommend it. We want you as the real estate professional, whether you're a loan officer or real estate agent, to be the gatekeeper. We want you to be able to provide them with that information and really be the subject matter expert. So we would rely on you to access DPA1, find those programs, and then there's sharing features within DPA1 that would allow you to share those programs with your borrower. And now moving on to the Q&A section. So I'm going to stop sharing now.
Quick question, David. This LPA choice, did I see a 10/13 submission date as the start date for these?
Yes. Thank you for mentioning that. So there's nothing that the loan officer necessarily needs to do. It did go into effect on October 13. So all you really need to do is run LPA. And if the loan that you're running is eligible, you'll get those feedback messages at the top of the feedback section within the feedback certificate. So nothing further to do other than just run LPA. Great question.
And one more. Will the findings have what the AMI income is on the findings?
I didn't understand the question. Can you repeat it again?
So I believe this messaging is there, but I don't look at LPAs every single day. It'll show what the, at the very least, what 100% AMI is. Will
Yes.
it show?
It will. And the only reason, and we actually have screenshots. Now, I didn't include them only because we want to make sure that loan officers don't confuse the AMI requirements with the HFA's income limits, because your income limits are generally over 80%, a lot of times over 100%. If you read that, you may think that that's a limit, and it's not. The limit is whatever the HFA sets. But within the feedback certificate, it's going to tell you, this is the income that we calculated, and this is what it equates to as the AMI for that particular property address. So it'll say your income of $67,000 is 78% of the AMI for the property address. So it'll clearly tell you what that is. But again, that's not to be confused with the HFA's income limits, which are generally higher, but you would want that information for the purposes of determining mortgage insurance coverage, right? If they're below 80, they would generally get the charter-based mortgage insurance.
Okay, so
David,
one more.
if you don't mind, I'll jump in just a minute.
Please.
Whether
Yes.
you choose Home Possible, HFA Advantage, or just a standard conventional loan, Loan Product Advisor, when it sees the income, will fire you the 50% AMI, the 80% AMI, and the 100% AMI. That way, if you as a loan officer forgot to choose something, it will give you an alert right off the bat what your income is that you're using. So you may find that that customer is eligible for an HFA and you forgot to give them that benefit.
Thank you. Yeah, great point. Absolutely.
Another question is qualifying or household, and LPA would show qualifying income. Another one is this also available in New York? LPA is across the nation.
LPAs across the nation. Off the top of my head, I don't know if Freddie Mac is part of New York's HFA program. So I can't tell you. Yeah, I would say just check with the HFA if they offer Freddie Mac. But if they do, then yes, absolutely, the feedback certificate would be the same. Oh, the New York question is about MI. Again, that would be subject to the HFA themselves and who they're allowing, whether it's Fannie, Freddie, FHA.
It's on qualifying income, Melissa.
Great questions. We love the engagement. Keep it coming. And then in the meantime, Rita, I believe we have some canned questions.
We do. We're going to turn the time over to Cheryl, or excuse me, I saw Charlotte, but it's Jean. Sorry about that. We've got a couple of beginning questions, talk about the underwriting piece. We'll give some opportunity for some additional as time goes on and time allows. So the first one's kind of complex. And Jean, I think you had a chance to review this last night. Is that true?
Yes, ma'am. Yeah,
Okay.
this morning I happened to sign in early and located your questions there.
Okay,
So
so this one
go
has
ahead.
to do with a server in a restaurant. She's been a server at the same restaurant for 9 years. Income was consistent in 22 and 23 with W-2s. In 24, she had surgery and was unable to work for 2.5 months, which makes her year-to-date earnings about $12,000 lower than the previous 2 years. She's been back in the same position with the same company since June. Her post-surgery earnings are commensurate with previous earnings. If not for the surgery, her earnings for 24 would be consistent with her 22 and 23 earnings. So there's a gap in work there. Can we include the time she wasn't working because she was recovering from surgery when calculating her income? Or do we still have to average it over 9.5 months?
All right. And I verified this one with risk management this morning. Okay. If the lender can document the one-time occurrence, then the 12-month seasoning would allow you to take that out of your calculation. If you cannot document that it was a one-time occurrence, then you're going to be forced to average it over at least the 12 months or based on the guide. And this is in the guide underneath the 5303.1D1 regarding the calculation method and trend analysis for declining income. And the reason I went there first is because on the surface, the income looked like it was declining, but you knew there was a special event that occurred, made the income decline for that. So it's really coming down to the underwriter being able to document the injury or one-time event that prevented the customer from making the steady income in there. And again, as an underwriter, if my customer was back to work maybe only a month since the surgery, I might have issues. You're wanting to make sure they've been back long enough that the underwriter feels they have the trend to support their back to making that income that they were before the event. Does that help, Rita?
It does. Can you give me that Freddie Mac section again, Jean?
Yes, ma'am. It's 5303.1, the letter D for fluctuating income, and then an I in parentheses, and inside the grid, it's calculation method and trend analysis, declining trend.
Oh dear. Okay, I'm just trying to take some notes here.
No,
Okay.
you're fine.
Okay, so everybody good on that? Any specific questions on that response? Okay, next question is, can you go over what Freddie Mac would consider deferred maintenance?
And this one, I went to my condo group this morning because I'm assuming that's what you were referring to when you had this question. And they did not give me a direct answer. They would say it is going to come into what the appraiser is saying. As an underwriter, things I would be looking for is my condo, they're not painting? Am I seeing things not being taken care of by the HOA? And those would also be the alerts to me, is the HOA having financial issues, which would make me definitely dig into the reserves and stuff. Because if they're not maintaining the property in a consistent manner, then that would make me say, am I putting the customer into a house that may continue to go down as far as the maintenance on the outside?
Okay, so on that particular question, this is directly related to a repurchase that we have dealt with in the past couple months.
Okay.
And it had to do with the appraisal reflected some moisture in the property. And I believe the condition on the appraisal was a C4. And if any of my teammates that work for Idaho Housing here in QC can help clarify this a little bit, jump on, I'd appreciate it. But I believe the condition was a C4, excuse me. But Freddie determined that there was issues with deferred maintenance on this property.
All right. Rita, if you can give me specifics on the side about that, I will be happy to go to quality control or the risk management and see if
Okay.
because I assumed, and I apologize for that, I assumed we were talking about condos, and I went to the
That's okay.
condo group this morning.
That's okay, because that's always good information.
Yeah, we were looking at more what the deferred maintenance would be, just in general, things that are unrelated to the overall health and safety of the property. Things that would just be typically wear and tear over time type examples.
Okay. So, I mean, I can give you an answer per my opinion, but I will be happy to bounce it off of risk management. If I'm doing a high LTV and I'm putting the customer into a house that I'm seeing that needs deferred, let's say needs painting, needs a new roof, and I know you have another question in here regarding the roof, okay? And I have a customer that is having to scrape up every dime to get into the property and doesn't have reserves to fall back on. I would begin to wonder, as part of my due diligent underwriting, am I getting the customer into a house that they may not be able to afford? And so now we get into the spirits of the things, but I will be happy to work with Rita on this if you want to give me some details. As I said, anything that, especially if it involves a repurchase or something that comes back, let's go back directly to the people and see if we can give you detailed answers. Okay?
That would be great. Thank you, Jean.
Well, just to follow up on that, so you are looking at the totality of the risk factors and potential compensating factors if they did have reserves and a lower loan to value. Is that correct?
As for me personally, yes, I would be. But I want to take and push it back to risk management, because that is part of the training that I went through, is to make sure I'm doing my due diligence in underwriting.
Perfect. Thank you.
Okay. Any additional questions on that one? Okay. All right, next question.
Sorry, just want to kind of reiterate that due diligence
Yep.
part is really key. regardless of everything else, it still needs to make sense for that particular borrower, because, of course, what we're really looking for is sustainability, not just get them into the home, but, have them keep that home. So again, keep that due diligence piece in mind. Okay, sorry, Rita, go ahead.
No, that's okay. Okay, this one came in, the timing was perfect. I hope this gal is on the call, but this one came in yesterday to my email box. I have a borrower who was working around 20 hours per week in 22 and 23, and through the beginning of 24. Sometime in 24, she dropped to around 10 hours a week plus tips. How would you calculate the amount of tip income to use in this scenario? And she included pay stubs and different things like that. Let's see. So year end, 23 pay stubs with the total pay. That's just documentation that she sent. So how would you calculate that reduction in work and then obviously the reduction in tips due to the reduced hours?
All right. I would be going back to the same area the guide you and I were looking at, because first of all, that tells me her hours have dropped over 50%, because you were telling me she was doing 20 plus hours a week. Now all of a sudden she's dropped 10 hours a week. Why has the income declined? I have to remember, as a lender, anytime whatever income I'm using to qualify, I'm repping and warranting that income for the next 3 years. Why all of a sudden do I have a drop in income? I definitely would not be wanting to average that income over the last 12 months or last 24 months, because I can't rep and warrant that she's going to be working 15 hours a week if the current paycheck is only telling me she's working 10 hours a week. So I would have to understand what is happening. And then this may be a definite prime example where I'm needing, since her income or her hours have dropped 10 hours a week, then I may be wanting 12 months now of this new hours to be able to rep and warrant that the minimum of 10 hours is what she's going to be working. Am I missing something on it?
I don't think so. I think you're good. Okay, thank you, Jean. Next one, I've got a quick, just spontaneous question in the Q&A. I have a new client who's been in the United States for 14 months from Ukraine. He has a salaried job for 5 months. Can we use prior Ukrainian employment?
You can use the Ukraine employment to prove he has a history of employment, okay? But when you're calculating the income, you are going to want to have at least, and I think I heard you say 14 months is in the US. Is that a 14-month employment history? Then at that point, depending on if he's paid by the hour, if it's a salary or whatever, then I would be working from there. Based on 5303.1, it tells me I can only use the income that is reported on their U.S. tax returns. So what I'm trying to say there is the income that he created in the Ukraine cannot be a consideration of your calculation, but it may be somebody that I can, and let's just use people that come to the U.S. to teach in the universities. We're a professor and maybe overseas. They're now here. They're on a salaried job. I'm using the 2 years both outside the U.S. and inside the U.S. to prove he has a history of employment.
And then what would you consider an acceptable verification of that employment in the Ukraine?
It could be, depending again on who you're getting it from, it could be a verification of employment. If I'm doing it from a university, I would most likely be able to prove it's a university over there or whatever. Okay. If it is not written in English, we have to have it converted to English per the guide. But I really am going to probably have to rely on depending on what type of employment I'm dealing with. Okay. And as underwriters, we all prefer third-party type of documentation. They were working for a family member in the Ukraine. I don't know whether that would be something that, as an underwriter, they feel like they can hang their hat on. Okay. So it's going to depend. I don't think there's one set of documents I would say would work over another.
Any additional input on that, anybody, before we move on? All right, next one has to do with the Schedule L. If you could go over alternative forms of business liquidity if Schedule L on business tax returns isn't completed. For example, no assets reporting, but has no liabilities.
All right, I'm going to use this one because Freddie Mac does not have a set form for me to perform a liquidity test on. And if you would have called and got me on the phone when we had a lot of people asking about a liquidity test, I would always give the example. If the guy coming to repair my refrigerator has his whole business on the back end of his truck, his liquidity is going to be totally different. Probably once he fixes my refrigerator, all he's having to do is replace that part. So his liquidity can be a lot smaller or maybe almost nothing at all because he's only having to purchase the parts and keep gas in his truck and make his truck payments. Okay. If I got somebody that is running a dress shop or a boutique of some kind, they're typically having to buy their merchandise anywhere between 90 days to 6 months in advance. So their liquidity needs are going to be a lot different from what what my refrigerator repairman's is. So I think that's going to be part of understanding what their self-employment is and determining exactly what you see that they need to be as part of their liquidity. Does that make sense?
That's to me. Looks like we got another question here. Okay, we'll come back to the Ukraine question here in a sec. Let's get through these others. Sorry, I'm trying to make some notes here. Okay, next question. Is variable income an automatic 24-month average? And if so, does that include gaps of employment? Also, does the 24-month history exclude gaps of employment?
All right. Again, first of all, 24-month average that we would be looking at on bonus income and commission income is normally in the guide 24 months. But in the 5303.1D2 this time, where we talk about additional fluctuating income, there is an area that is titled Income History and Stability, Requirements and Guidance. And it does state that there are times I can use less than a 24-month history, but under no circumstances can I use less than a 12-month history. But as an underwriter, I have to build my justification for that. All right. If I had a one-time event, using our example of somebody that was in the hospital, okay, or had surgery, and I could document it, then that may be part of my justification in there. Okay.
Okay. Comments, questions? Okay, let's see. How about, we'll go back to the Ukraine question. If the borrower has had his full-time job for 5 months and we have a written VOE from the employer that he makes a certain salary, we would not be able to use their income?
I don't know. Okay, so when you're using the terminology salary, okay, I'm not having to meet the 12-month requirements like I do for fluctuating income.
Hmm.
If you're saying he is and I'm going to use the university as another prime example. The university is paying him $100,000 a year, then I've got something that says what my annual income is, and I'm not having to document that 12-month history. If he is paid by the hour, or his hours or his income fluctuates, using the example of maybe going to work in a factory or something, then I am going to need that 12 months.
We good on that one, Dee? Let's see what we got here. Okay, I'm gonna go back. There's two more of our canned, and then I'll go back to yours, Leanne. If an appraiser states roof is at the end of life, is a roof certification stating 5 years remains sufficient and acceptable to Freddie, or what would your requirement be?
Freddie is silent on this, okay? And I know from having underwritten for quite a few years, it used to be that the life expectancy had to be at least 5 years. We no longer address that. But I'm still going to use the fact if I'm doing a high LTV, I'm putting the customer into a home and I'm using every bit of money to get them in that home. And the appraiser is telling me that this roof needs to be replaced. Am I benefiting the customer by putting them in this house? Most likely, if the roof is in bad shape, they may not be able to get insurance for it, which would really make me worry about, if the insurance company isn't going to insure it, it's probably better for me to go ahead and say we need to put on a new roof to help the customer.
Okay. Let's see. Let's go to Leanne's question. If a borrower has capital gains as part of his income, and we all know capital gains go up and down each year depending on what they sell, depending on what they can sell. Can we always use a 24-month average, or is the current year, if the current year is lower, do we have to use just that year?
All right. It all depends based on 5305.2 what the capital gains is. Still remembering in the back of your mind, whatever income I'm using to qualify with, I'm repping and warranting that income will continue for the next 3 years. Anytime, no matter what that income is, I'm seeing that it has dropped in the current year compared to what it is in the previous year, I've got to investigate why. Will it continue to drop? Has that customer sold? Maybe if the capital gains is from stocks or whatever, which is the reason we ask you to evidence that they still got enough assets to create that income, then I may not be able to use that average. And I would need to look at what they currently have. It may not even generate the income what they show on their tax returns from 2023. Again, as an underwriter, I've got to build my justification for why I'm accepting it and how I'm doing my calculation.
Okay, thank you. That help, Leanne? I've got one more, and then we have another canned one that we'll finish with. How would you factor?
RSU. Go ahead.
I apologize. That's all right. How would you factor in a raise for that hourly employee?
All right. That is on our frequently asked questions for stable income in the guide. And it gives you 2 examples in those frequently asked questions. And it probably the easiest one to work with, and I'm doing this off the top of my head, so I apologize. Talks about a customer that was getting $25 an hour and is now getting $28 an hour. If I can calculate using the minimum of at least 12 months, and I think in the example they have like 14 months where I can get from the employer or be able to calculate from the W-2 how many hours they averaged working a month, and then document that with the year-to-date earnings. If I can document at least over a 12-month average what they average to work in hours, then I can take those hours and use that new income to calculate the raise that the customer has gotten. Did I answer that? Or am I?
I think so. No, I think you're good. I'm just watching the chat to see if we have any other comments on it as you speak. That's all. Okay. We good on that one? Oh, let's see. Okay, along the same lines, to make it more complicated, with the nurse, they earn differential income.
Yes, and my granddaughter is a nurse, so I totally understand that. She works for Methodist Hospital in Houston, and she works 12-hour shifts, and depending on what shift she's working, she gets shift differentials. So just like you would on a factory worker, okay? And for her, I have to have a 12-month history, because then I've got to average out what is the hours that she typically works per month with that. Okay. And hers, because let's say there's a certain rate of pay for day, a certain rate of pay for evening, and then a certain rate of pay for the midnight shift. I may have to take and average her income over that 12-month history to make the determination what would be the income that I am comfortable with and using to qualify.
Misha, did that answer your question? Let's see, with the hourly at the new rate. Sorry, I keep getting pop-ups that keep blocking this. Would the hourly at the new rate of pay be a separate calculation than the differential pay?
It could be. It's all going to depend on what you can document. All right. Using the example of my granddaughter working for the Methodist Hospital, for the same hospital for years, I might accidentally be able to say that she averaged, let's say, 20 hours a week at regular pay, and then another 10 at maybe time and a half, and however the structure is. If I could document it, then I could possibly take and use the pay raise and make it work that way. Again, it's going to be you building justification and documentation supporting your decision as to how you felt comfortable in the income you're using to qualify.
Okay, on that same question, regarding current question, oh, it went away. Can we use the lowest pay rate to qualify less than 12-month history? I'm not sure. Oh, I'm not sure I understand, Kara. Can you use the lowest pay rate to qualify less than 12-month history?
All right. I know in the frequently asked questions, there's 2 or 3 areas that said I cannot use anything than the less than a 12 months calculation. Now, there is a section that you and I were looking at with our first question that is in regards to declining income. And it talks about if my income has declined more than 30%, I'm not able to use the average of the previous year with the current year. I would have to use the lower income to qualify. So on that one, if I'm not answering the question what you're looking for, let's get more details and I'll be happy to research it for you. Okay?
Okay, and we are 12:14 right now. We've got about 15 minutes. There's a couple of questions. There's one in the Q&A, and then there's another one that has to do with RSU income. I want to address something else that seems to be recurring. And then if we have time to take care of these questions during the meeting, we can do that. Otherwise, we'll get them answered and get them sent out to the entire group. But one last question is on the LPA findings. And John, you want to help me on structuring this question? Using LPA findings as gospel truth on the approval of a loan, how would you guide these folks, Jean, as far as partnering the guide to the LPA findings?
All right.
John, you want to clarify that a little bit? John knows where I'm going with this.
No, and that's, I mean, that's essentially it. We, for our lenders and for us in general, the LPA serves as, I mean, you hear a lot of times, follow the findings, just make sure you're following the findings, but, which I think for the most part is true, but what happens is that mentality morphs into, the findings are, I mean, that's all we need to rely on. If we meet the findings, then we're good, which there are some situations where that isn't always the case. And we're asked to, you know, when we've seen in a couple of these repurchases, we're asked to refer back to the guide because the findings seem to indicate that we were okay. So, I mean, follow the findings can be kind of a blanket scenario that we probably want some clarification as to how do we utilize the findings along with the guide and to make sure that these are being underwritten or documented properly.
I'm sorry, hold on.
Rita, it looks like she's going to fall into the ocean.
Rita, were you telling everybody here to hold on, or were you telling somebody else to hold on?
No, I was trying to mute myself. I apologize. The phone kept ringing.
Okay. All right. So first of all, we know any automated underwriting system is only as good as the information you put in there. Okay. So, and I'm going to start off with 5101.2, the accuracy of the data that is submitted to Loan Product Advisor. You as a lender are repping and warranting that you are submitting everything to Loan Product Advisor as correctly as you can. Okay. So I always start off with that. If I've entered it as directly as I can, and I've entered the information, if it's commission income, if I've identified it as commission, if it's overtime, I've identified it as overtime, because every one of those items has a different risk factor built inside of it as part of its, I know they don't like us using the terminology black box, but it's what it is. That's part of the rules that are built into it. And my risk management changes those rules based on what they're seeing to the market. Every lender does that, whether it's their own proprietary system or what. But it's my responsibility as a lender to make sure everything is submitted correctly. Now, having said that, a automated system is only as good as the data submitted to it. But there are things that an automated system cannot be aware of. I happen to be underwriting a file where I've read in the newspaper that a company is going to be shut down. Well, I know this customer works for that company. So that falls into something that me as a lender is aware of that an automated system would not be aware of on it. So my reps and warrants would be covering into that too. Okay. If I've submitted everything as correct as possible, and if I have know everything on the credit report is as correct as possible, and there's nothing that I'm aware of that the automated system would not be aware of, then typically I should be able to sell that loan and Freddie Mac take on the reps and warrants without any issues. Now, I've not heard of any issues, and you may have to give me some examples as to what you've had come back to you on that would lead me to believe it was something you should have known of in advance on it. Am I getting anywhere close?
Yeah, well,
No,
yeah,
and that, go ahead, Rita.
go ahead, John.
Oh,
Go ahead,
and
John.
your feedback and answer is, I think, makes sense and is more than fair. I unfortunately don't have a specific example. We have seen a couple that, whether the findings were ambiguous or maybe didn't, I felt like in the repurchase request that the repurchase request reached beyond the findings or something, and there was a concern that wasn't necessarily known or that wasn't stated in the LPA. So there's just been a couple where it's like, well, they seem to be following the findings, and it doesn't seem like there's information out there that would contradict it. But then it was questioned because the guide presented it a little differently. So those little discrepancies. Some may be minor, but have certainly presented themselves to us over the last 6 months. So I just was curious as to how interacting with the guide and how you would do it on your end. So you did answer that question, but there is a couple things that still may contradict that.
All right. Well, and I know this is going to be a little bit out of my realm, but I will be happy to work with David on this if you want to give him some examples, and let's see if between him and I, if we cannot visit with our risk management area and maybe get some assistance to help all of us understand what the issues were on your examples. Okay, and let's look at it. Is that all right, David?
Yeah, absolutely.
I appreciate that.
You got anything else, John, while I'm typing?
No, I think we're pretty good on the questions. There's a few here, but I think for the most part that we have them. We've had that restricted stock unit one. I think you're going to try to address that next if we have time.
Yeah, do you want to just read that to Jean while I'm typing?
You bet. Let me, okay. Jean, for restricted stock unit income, does the history of receipt depend on when a borrower begins receiving unvested stocks on their pay stubs, or does it start when the stocks vest according to the vesting schedule?
I think that differs, and bear with me. I'm going to the 5303.1 where we talk about it. I think it differs as to whether it's performance based or if it's time based. So bear with me on that. We don't get that many phone calls on RSUs.
So if I name a subject, can you give me the exact place in the guide where I'm going to find the answer, Jean?
Oh yeah, go to Well, on RSUs, that's under the 5303.1, underneath little d, big D. All right. And if it's performance based, we talk about a 2-year history. If it's time based, we have a 1-year history. So let me look at this real quick. To be considered, the history of receipt of the RSU used for qualifying must have vested and been dispersed to the borrower. So that 2-year history under the performance base must be vested stock, is how it reads. Let me go down to the time base and let's see how it reads. It only requires a 1-year history, and it says to be considered for history of receipt. It also uses the term used for qualifying must have been vested and have been dispersed to the bar. So both of them require them to be vested and have been dispersed to the bar. So if I'm looking at the time base, then that tells me they must have been receiving it, been vested and received for at least 1 year. And then if it's performance based, it's going to be vested and received for 2 years.
Thank you.
I think that's great. And-
There is one more question, unless you have an extension on that, John.
No, I'd seen one more, but you're probably,
The nurse question, go ahead.
yeah, go ahead.
Okay, nurse right out of college and has been on the job for 6 months now. Can we use base rate income at minimum guaranteed hours? So let's say lowest pay is 35 hours and working 36-hour minimum per week.
That
Or
question is
35
in
per
the,
hour.
okay, that question is in the frequently asked questions, and because a nurse, especially if they're working in a hospital or most offices are paid by the hour, risk management has told us I must have a minimum, even if they have guaranteed hours, I still must have that 12-month history. So it appears there is no exception when I'm using fluctuating income for anything less than 12 months.
Okay. Looks like we have an extension of the RSU coming in. Okay, so we're at 12:27. We will be sending out a survey with some fairly pointed questions, and that will also give you the opportunity to ask additional questions. And we will do our best to turn these around as quickly as possible. Hopefully the survey will go out tomorrow morning. Keep in mind that there are a lot of people on this call. This is kind of unprecedented for us. We'll do our best to get that survey out. There will be a link to this recording in that survey. And then we will return with an email to everyone with a list of questions and those answers. So it will be a one-stop shop. So you'll have everything together. Thank you guys so much for coming. We appreciate this, and we do hear you as far as letting us know that this is very much needed and wanted. And we so appreciate our partnership with David and Jean and Freddie Mac and their willingness to be here and address these questions. But thank you guys for coming. I'll let David and Jean and John make some closing comments as well.
The only thing I have would be to follow, as far as follow-up in questions and survey, that piece is great. Also, any feedback you have on what you'd like to see for future sessions like this is great. If we know what you need, we're better able to, and we don't want to always anticipate that. If we miss something, we want to know about it. So please share your needs with us and what you might want future engagements like this to look like.
The only thing
Go
I'll
ahead,
add
David.
is
Go ahead.
I've seen some really great positive feedback, especially for Jean. And as you can see, Jean is a wealth of knowledge and just a fantastic resource. Well, you can call Jean. She is within our call center at 1-800-FREDDIE. So you may not speak directly with Jean, but we have many underwriters who are highly trained, specifically in HFA. They're very familiar with it. So if you do have questions like the ones we reviewed, specific scenarios, you can call 1-800-FREDDIE and speak directly to our underwriters like Jean, who can help answer any of your questions. And with that said, as John and Rita mentioned before, we look to do more of these. And so we would love your feedback as to what information you're looking for so we can provide that for you. And with that, that's all I have to say. Thank you for your partnership. Thank you for considering using Freddie Mac. And we appreciate your time. We hope it was very valuable to you.
Thank you all.